This episode is brought to you by Matcha. Stay tuned for more information about them later in the episode. What's up, everybody? I'm Scott Melker, and this is the Wolf of Wall Street's podcast, where twice a week I talk to your favorite personalities from the worlds of Bitcoin, finance, trading, art, music, sports, and politics, anyone with a good story to tell. Now, one of the biggest news stories in crypto last year was MicroStrategy, a business intelligence company publicly announcing the decision to buy $425 million worth of Bitcoin with their cash reserves. Since then, the trailblazer behind this company, who is today's guest, has continued to do what he believes in most, which is buy more Bitcoin. Rather than just leave it as a one-time purchase, Michael Saylor has put it all on the line to effectively go all in on what he believes is the future of money and a catalyst for a better world. Beyond just buying Bitcoin, Michael Saylor has become an important figure in the space, advocating for improved mining conditions, open source information, and honest education. He's prepared to fight and die on this hill, clearly. It's an absolute pleasure to have him back on the show today to discuss all the developments that have taken place since he first bought Bitcoin, what his plans are for the rest of the year, and his current thoughts on the market. Michael Saylor, welcome back. Thank you so much for being here again.
Thank you.
So I just interviewed Vijay Boyapati about his book, The Bullish Case for Bitcoin, for which you wrote the foreword. On the cover, there's a very intense drawing of a bull in armor with a hammer. So I'm curious if that is a portrait of you.
No comment.
It's pretty awesome cover.
I'm your kinder, gentler Bitcoin evangelist. I believe we should be cheerfully evangelizing Bitcoin in a non-intimidating fashion to bring hope and good cheer to the general public.
Well, let's hope. So listen, the more Bitcoin you buy, seemingly the more detractors you accumulate. We keep hearing the argument that MicroStrategy could fail if Bitcoin drops too far, that you're overcommitted to the asset. I'm curious what you say in response to those comments.
Well, the company's stock was 120 when we started this journey, and we had $60 a share in cash. And we were under a lot of pressure to return that cash to the shareholders because, the S&P is up 40% over the year. And so if you actually sat on 500 million in cash for a year instead of investing in the S&P, that's a $200 million loss. So I could see that clearly. I mean, some people don't see that clearly, but it couldn't be clearer now. If you look back, a 40% gain in the S&P over 12 months is the message that the currency devalued 40%. So we had to do something. So we could have just returned the 500 million in cash. We would have had $60 a share. We would have a company growing 0 to 10% a year with $60 a share, and no one would know about us. And the shareholders, I don't think, would be better in that regard. I mean, I'm looking right now at the stock and it's showing $675 a share. Okay, so 11x, I could have been $60 a share trying to get to 100, but we're now at $675 a share. So what did we do next? Well, the stock doubled, and then we sold a convertible note that converts at $398 a share. That was unsecured. So that convert is $650 million of debt, but it yields 75 basis points. So, take less than 1% of $650 million, $5 million a year in interest. Okay, so I agreed to borrow $650 million at $5 million a year in interest. We generated $115 million in cash flow in the last 12 months. Okay, it's a $500 million company generating 80, 100, $110 million in cash flow a year. So I basically take 5 million of it, I borrow a bunch of money, and I got to invest in something. Now people think, like, the entire world, Scott, revolves around people doing debt and equity financing to invest in businesses. Every building in the world was debt financed. Vegas is debt financed, right? Every company is either equity or debt financed. The entire cable industry, the telco industry, the airline industry, the railroad industry, right? They're all debt financed. So using debt to grow a business is business. That's why Wall Street exists. That's why there is hundreds of trillions of dollars of equity and debt floating around. So we did the first financing, the convert, then we did the second convert. And the second convert was we borrowed $1.05 billion at 0% interest. Okay, so if I walked up to you right now and I said, Scott, I will give you $1 billion at 0% interest for the next 6 years, and you can invest it in a business of your choice. You either have a business that you are bullish on or you don't, right? First question, would you take the money?
Of course.
Of course you take the money. Okay, McDonald's, has debt how many, find me an S&P 500 company that doesn't have some debt. Like maybe a few, but it seems like if someone wants to loan you $1 billion at 0% interest, you would invest it. So the question is, what's the least risky thing you can invest it in? I happen to think that that Bitcoin is big tech without all the risks of big tech. So if I offered you $1 billion and at 0% interest, would you buy the S&P 500 index with it?
Not now.
Now it's looking risky, but if you'd done it a year ago, it's probably a good idea, right?
Sure.
And if you had actually done it 6 months ago, you still would be up. Would you buy big tech, Apple, Amazon, Facebook, Google? Well, they're all-time highs right now, I think. So I think that if you asked any investor in the world, would you borrow $1 billion at 0% interest to invest in your investment strategy? Like, if it was fixed and it wasn't marked to market, then I think they would say yes as a general rule. So what we did there was kind of obvious. And then the last financing we did was the stock was down $400 a share. And we could have sold $400 million worth of equity, but it would have been 10% dilutive, and bought Bitcoin with it. But instead of that, issuing $400 million in debt at 6 1/8% interest doesn't dilute the common stock shareholders, and it doesn't dilute the convert holders either. And so would you borrow money at 6% interest for 7 years? Well, if you thought that the thing you were investing in was going to go up at more than 6 1/8%, you would. I did a survey on Twitter and I got 120,000 responses. And it was 90%. I asked, do you think Bitcoin's going to go up more than 6 1/8% interest over the next 7 years? It was very, very precise. Happens to be aligned with that bond. The answer is 90% of the people on Twitter that follow me think, yeah, it is. So there's the 10% of people that I guess that are, if you don't think Bitcoin is going up 7% a year, then I guess you're short Bitcoin. It turns out that MicroStrategy is a publicly traded company. We have gone through a lot of work, a lot of shareholder relations work to rotate our entire shareholder base to be long Bitcoin. There's no one that owns MSTR stock that hates Bitcoin, right? Right. And by the way, when I started on this journey in August, in July, I put out a press release, and the press release was, we've got 500 million in cash. We think we need to buy some asset as an inflation hedge. And so we're going to buy 250 million worth of an asset, and we're going to return 250 million worth of cash to the shareholders over the next year. Okay. And then a week went by, the stock was 120. It traded 20,000 shares a day. No one noticed. No one cared. We're going to buy 250 million of your stock back. Nobody cares. 7 days later, we accelerated it. We have a Dutch auction. We're going to buy 250 million worth of your stock back at up to $140 a share at a premium. And we just bought Bitcoin. Now 20 days goes by. Everybody that hates Bitcoin, that short Bitcoin, either got to sell above 140. They sold between 140 and 155, or they got to sell into that tender offer, and you get to get off the train. You don't have to be invested in the company. And at that point, we had substantially rotated our shareholder base. The way I know we rotated our shareholder base is we only had $60 million of shares tendered.
Right.
If we had had $250 million of shares tendered, you couldn't be sure that you bought out everyone that disagreed with the strategy, right? But if you only have 60 million out of the 250 million tendered at a premium, where the stock was trading 120 the previous week, then you kind of know that everyone that disagreed with you is already sold, and you've only got 60 million people that are skeptical. They tender, and at that point we've gone net long Bitcoin. So my answer to everybody is, my shareholder base is long Bitcoin. If you're a Bitcoin hater, you got 5,000 other companies you can invest in NASDAQ and NICE. You don't have to buy MicroStrategy. I'm not trying to convince everybody they should own Bitcoin. I'm just pursuing a strategy where we believe in Bitcoin. And if you believe in Bitcoin and you want to be long Bitcoin, and the person running the company said, guys, I have a chance to borrow $1 billion at 0% interest and buy more of the thing that you love, should I? Well, of course you should, because you wanted to own the Bitcoin. If you like Bitcoin, and you can have $1 billion of it, and if someone said, I'll give you $2 billion of it for free, how do you not like that? I'm pursuing, and the company is pursuing, a long leveraged Bitcoin strategy. And now the question is, am I putting the company at risk? Well, Scott, I could go and pledge $1 billion of Bitcoin, and I could take out a margin loan to value 50%, mark to market, and I could buy Bitcoin. Heck, I could buy Bitcoin on 10-to-1 leverage, maybe if I wanted to twist it. But we're not doing debt that's mark to market, and we're not pledging the Bitcoin, right? So our convertible debt is unsecured. So Bitcoin could go to zero. The debt doesn't default. If Bitcoin price goes from 35,000 to 10,000 to 5,000, the debt's not in default. Okay, so if Bitcoin goes to zero and stays there forever, then our business strategy will not have worked. And at some point, we'll have to do a dilutive financing. We would issue, in that case, if Bitcoin went down, if it went to 20,000, then I would end up issuing equity, probably, in order to refinance the debt. But if Bitcoin jerks down 80% overnight, the difference between permanent debt and margin loan is, if Bitcoin jerks down 80% for 1 week, you get forced liquidated and you get wiped out as a trader. And that's why that's a bad idea. And is that likely? Yeah, that could happen in the next 5 years, right? You could have some cataclysmic Black Thursday event, right? A meteorite or whatever. But that's not the same as calculating the statistical likelihood that Bitcoin jerks down 80% and stays there forever.
Right.
Right. And so they're different. And if you look at the senior debt we just did, we basically financed the cash flows of a software company. So I could either wait for a decade, or I could wait for 7 years to buy $500 million worth of Bitcoin, or I can finance it up front and buy 500 million now and pay 6 1/8% interest to do that. We pledge the intellectual property of the company, and we pledge the cash flows of a software company. And we probably could have done the deal just based on those two. And I'm taking a company with cash flows growing 0 to 10% a year, and I'm putting it into an instrument which is up 120% a year for 10 years running. That's up 280% or 290% this year, whatever it is. Okay, so is it risky? Sure it is. That's why we're the company doing it, and we disclose it in the risk factors in our 10K and our 10Q. If you don't want to own Bitcoin, then you don't want to own MicroStrategy because Bitcoin is a risk. But you know what else is a risk? Everything. Running a cruise line is a risk. Running an airline is a risk. Tesla sells cars. Cars blow up. Guns, shoot people. You get sued for it. Tobacco gives you cancer. There are plenty of businesses that have risk factors. Our risk factor is laser focused, fully disclosed. And the risk factor is Bitcoin is not the digital property that everybody needs. It's something different. If you believe that it's digital property, then you buy MSTR, or you might buy a convert, or you might buy our debt. You get paid to do that. There's a benefit. If you took the risk on MicroStrategy, the stock went from 120 to 675 in 10 months. If you took that risk, if you actually take the risk of a company owning Bitcoin on its balance sheet to buy our debt, you're getting paid 6.18% interest. The companies that didn't have Bitcoin were paying 4% interest. The junk bond index is 3.9% interest. You can buy a company losing money, and you can loan them money so they can buy their stock back and get paid 4% interest. Is that a bigger risk or a lesser risk? People are loaning money to Apple at 2% or 1% interest. So you're getting paid a fat yield in order to own a different instrument. And of course, with that piece of debt, we actually we bought $500 million of Bitcoin with $500 million in debt. Well, technically we bought $487 million of Bitcoin with $500 million in debt. There are fees to be paid to the banks to issue the debt. And now you've got a collateral package, which consists of, you'll probably get paid with cash flows. If that doesn't work, you'll get paid with the Bitcoin. If that doesn't work, you've got a claim on the intellectual property of the company. Is the company worth more than $500 million? Well, it's been worth more than $500 million for 20 years. So probably you're senior. So I guess I laid out why would someone want to buy the debt or the equity? Why is it good for the company? Well, because we're financing all these things with in a non-mark-to-market fashion over long periods of time, and we're highly confident. Let's take the total debt. We have $2.2 billion in debt, I guess, and we're paying 6%. We're paying $35 million a year in interest. Okay, what's my effective interest rate on $2.2 billion at 35 million? Right? Is that like 1%, 1.5%? Mm-hmm. Okay, so we've got about a 5 to 7 year loan at 1.5% interest. Now let's run the survey. If I asked everybody that follows you on Twitter, is Bitcoin going to go up more than 1.5% a year for the next 5 years? What's the vote?
99%.
Okay, so under what circumstances people go, well, what if it trades below 26,000? Okay, so what if it trades at 20,000? Okay, what if it trades at 10,000? Well, if it trades at 10,000 in 5 years, you'll probably read a headline like MicroStrategy refinanced its debt by issuing some equity. Okay.
Guys, I really hope that all of you are not still trading on the old platforms like Uniswap when there are much better options like Matcha, and now Matcha has upgraded to 2.0. Now, I've told you about Matcha a number of times. They have limit orders, which these other platforms don't, which is absolutely incredible. So you don't have to sit there staring at your screen waiting for that perfect moment to enter or exit a trade. And they also aggregate liquidity from all of the different platforms, finding you the best price and reduced fees. But now they have Matcha 2.0 and have added so many awesome features. Matcha is now the only DEX with an integrated fiat on-ramp. You can put your dollars directly onto the platform. They also now have OTC trading for orders between 1K and 1 million, which is beyond huge. And maybe most importantly, Matcha now supports trading on Polygon, meaning that those gas fees will almost evaporate completely. Now, if you guys want to check out Matcha, which you absolutely should, you can do that at thewolfofallstreets.link/Matcha. That's thewolfofallstreets.link/Matcha. Please check them out. I'm telling you, it will save you so much money and is such a superior experience. Do it now. Doesn't the very fact that people concentrate on those numbers show extreme short-term mentality and that they're completely missing the point, because it's assuming that there's a trigger for you to sell just because for one moment you're underwater, which clearly is not the case for any long-term investor or any long-term investment.
Yeah, I think that that Twitter, there's a lot of people on, on Twitter and on the Reddit groups and the like, and they want to talk about get rich quick schemes or trading schemes, and they want to tell you how to trade this week. And I've been pretty consistent, I think, ever in all my interviews, I've said, I don't really know what'll happen this week, this month. I'm not even sure about this year. Like, there's nothing that I would invest in where I have less than a 10-year time horizon. So I think Amazon was a good investment. When should you have sold it? Never. I thought Facebook was a good investment. I bought it before it came public. When should you have sold it? Never. It just hit $1 trillion. I thought Apple was a good investment. Amazon traded down 95%, Scott. I remember it traded down 95%. Should you have sold it? No. The richest man in the world didn't sell it when it traded down 95%. What's the difference with how about, Microsoft, like they got rich by holding Microsoft stock for a long time. So I think that trading is a very difficult business. 1% of the world can do it. If you're a good trader, then you're a good trader. Presumably you have proprietary information flow, proprietary models. If you're lucky, you're a market maker and you get in between, you arbitrage out, some inefficiency. And if you do it, you keep it to yourself, or the like. I think fundamentally, the big idea with Bitcoin is technology. It's technology to distribute property rights to 8 billion people. If I want to give education to 8 billion people for free, you don't do it with books and libraries and bricks and mortar institutions. You do it with digital books and digital lectures on YouTube. And if I want to give joy to 8 billion people, you don't do it with Steinway pianos and orchestras and CDs and records. You do it with digital music for free. You pay $9 a month and get 50 million songs, and you pay $15 a month and you give it to your family with the family plan. And for $3 a month, you can give 50 million songs to your daughter or your wife. That's how you give music to the world, digital music. If you want to give wealth to the world, if you want to make the world rich, you give them digital property. You cannot do it with gold. You can't distribute an ounce of gold. You can't do it with land. You cannot buy $387 worth of land. You can't take the land with you. The gold gets seized. It gets mined. The property gets taxed. The tax rate in Florida is 2% a year. If you put your money in land anywhere, the property gets impaired. You cannot move it. You can't buy a building. You can't give a building to 8 billion people. It's pretty clear you cannot give physical property to 8 billion people. You have to give digital property, digital music, digital books, digital photos, digital communications, digital everything. The reason Facebook's $1 trillion company is digital, right? Google, Facebook, Apple, Amazon, Bitcoin, digital something. Now, in all of those cases, you have to have a 10-year time horizon. You have to basically buy it and wait 10 years. So when I'm looking at Bitcoin, I'm not a trader. I shake my head. I feel sorry for them. It's like, give me an example of a billionaire that made $1 billion shorting Apple, Amazon, Facebook, or Google stock with trading algorithms. Name one.
You can't even name a millionaire, probably.
It's you're gonna short or trade Bitcoin. It's like shorting and trading Amazon stock. Yeah, it's like you can find and cherry pick a 12-week time period when maybe you got short and you are correct. I mean, I have people on Twitter and they post, yeah, Saylor, he told people to mortgage their house, sell their house to buy Bitcoin when it's 60,000. Well, no, I mean, first of all, I told people to buy Bitcoin when it was 9,500. They leave out that part, very famously. You remember what it was like? What was it, like 18,000 or so when we spoke last year? I mean, it must have been in the teens. So I've been consistently telling people Bitcoin was a good idea since I bought it, and I started buying it in the mid 9,000s. And I've never told someone to sell it, and I never told them to trade it. And my position on mortgaging is, no, you shouldn't sell your house. Keep your house. I like houses. But if somebody wants to loan you money against your house at 2.5% interest for 30 years without marking it to market, and you have a business, you ought to take the money and invest it in your business. And if you have a portfolio that you believe in, truthfully, it's probably a better idea to take the 2.5% money and put it into a broad equity index today, given money printing, than not. Like, I don't think that equity is the best store of value, but I think given a choice between investing $1 million in the US dollar and watching it be debased at 10 to 20% a year, or investing or taking the $1 million loan from the bank at 2.5% interest and buying a diversified portfolio of stocks, I would probably do the latter. I would probably obviously I would buy Bitcoin with money that cost me 2.5%. And I would probably, if I couldn't decide to buy stocks or Bitcoin, I would buy land. Like, buy your house. I mean, clearly, like buy, someone wants to, there are people getting these 5 and 7 and 10-year ARMs at 1.5% interest. So for the conventional person, a consumer that does not have a publicly traded entity that's financeable, your cheapest source of funds that is simultaneously your safest source of funds is mortgage debt. Like, you could borrow money at, I could borrow money at LIBOR plus 50 basis points against its stock portfolio, but it is mark to market. And if the stock portfolio trades down 80%, you will get a margin call. They will force liquidate you and they will take your property. And so that's a cheap source of funds, LIBOR plus 50 basis points, but that's not nearly as good as LIBOR plus 150 basis points or LIBOR plus 200 basis points for 10 to 30 years without mark to market. And so if you understand the stochastics of this and the volatility, there's nobody in the world, I think, that has a better source of funding than a 2 or 2.5% mortgage against real estate, because that's being subsidized by Fannie Mae and Freddie Mac and the US government. They're creating subsidized financing. So when someone says you shouldn't borrow against your house, or I'm going to sell Bitcoin, so I'm going to sell Bitcoin that traded up 294% this year so that I can pay off my mortgage. I basically sold $1 million worth of Bitcoin, lost 294% yield so that I could avoid paying 2% or 2.5% interest. So I could hold $1 million, which lost somewhere between 20 and 40% of its value in 12 months. Okay, so the haters, they just hate Bitcoin, so they want to generate a line, but you're telling people to give up an asset portfolio. Forget about Bitcoin. What if it was just S&P? Would you sell S&P portfolio $1 million, lose 40% gain so that you could avoid a 2% interest rate, so that you could hold money that was losing 20% of its value against scarce assets? I just don't think it's good. So in an inflationary environment, if you can finance at a rate that's lower than the monetary expansion rate, when the monetary inflation rate 7% and you can finance at 2%, there's an obvious arbitrage. When the S&P is yielding 10% a year for 100 years, if someone was willing to give you infinite money at 2% interest, the only thing you got to do is ask the question, is it mark to market? If someone said, I'll give you 100-year loan at 2% interest, and you bought the S&P index, isn't it obvious that you're going to scrape the 8% arbitrage with no liquidation risk?
Yes.
Yeah. So if it's 30 years, probably. right? So it really just comes down to, am I borrowing money that's marked to market every minute of the day, and I go to 10x leverage? Then you got liquidation, which you will probably be forced liquidated on a, on a crystal ball. If you're doing, some kind of stochastic forecast, and you pump into your forecast 100,000 possibilities, you probably get forced liquidated in 98% of them because of some black swan event. But if you get out to 5 to 10-year financing or more, you probably don't. And of course, if you're financing an asset, a house that is not marked to market, okay, how many people have ever told you the story of, my bank showed up, reassessed my property down 50%, called the mortgage and liquidated and wiped me out, and I'm bankrupt? Have you ever heard that story?
No.
No. So it's kind of silly for people to say, it's a bad idea to take on a home equity loan or a mortgage loan. I mean, it's much riskier to take on a mark-to-market loan, but I mean, you can do the tranche, right? 30-year mortgage against a home is probably the least risky. 10%, a 10-year mortgage, a bit more risky. A 5-year to 10-year note against a business with no conditions of default, a little bit more risky. When you start a 10-year mortgage or 5-year mortgage against an asset portfolio that gets assessed in 5 years, more risky. A mark to market up to 50% loan to value, that's risky. 10% loan to value, less risky. 20x leverage, super risky. So MicroStrategy, right? Like, we actually took an uncorrelated asset, our enterprise software business that generates cash flows. We pledged that in order to raise debt to invest in Bitcoin. So we're actually very intelligent about the way that we construct the debt and the capital structure. If I wanted to make it riskier, then I would securitize the Bitcoin directly. And if I wanted to make it more risky, I would simply post the Bitcoin and I borrow 10% against it. And if I wanted to make it more risky, I'd run up to 50% loan to value. Right. And so there are ways to construct a tower of risk in a capital structure. But most people on Twitter, right, I don't see a lot of parsing. I suspect that 99% of the people that would criticize us for doing this haven't even read the debt instrument or the SEC filings. They don't,
or they wouldn't understand it if they read it. And I was just going to say, I think your average person in this country has a fear of debt or a lack of financial education, which is not provided by the system. And so you have this sort of binary debt is bad feeling, and don't understand that, taking 2% interest on a mortgage and paying the same $2,500 payment 30 years from now as today is obviously, with inflation, a far cheaper payment and is the best bet to make every time. And you can take money right now and park it in USDC and earn 9% with that loan and do absolutely nothing. And theoretically, if you believe in gaining yield, you can buy Bitcoin and get 6.5% if you trust the platforms and are comfortable with the counterparty risk. I'm curious if you, as a company, have explored any of the yield strategies for your holdings.
Yeah, I talk to everybody in the market, and I keep track of what's going on. Believe it or not, Scott, I'm still in my rookie year. Like, I haven't gone 1 year in Bitcoin. So this is our first year. And our first year, our focus was do the equity financing to buy Bitcoin, do the first convert to buy Bitcoin with our cash flows, but do the second convert to buy Bitcoin, then do the secured financing to buy Bitcoin, and then make sure that we communicate and we build institutional awareness, and we had to educate our auditors, and we have to educate our lawyers, we have to educate our shareholders, we have to educate the general public. So in that environment, during that time frame, Bitcoin is up 294%. So those yield offerings might have yielded, what would they yield? 4% on Bitcoin. So I might have got 4% more. I go from 298% to 302%.
Right.
But I can tell you, as a public company officer, my risk and my regulatory headache and my legal headache and my accounting headache would have been 10x higher. So I would have, I would have put my finance team through 10x as much complexity in order to get comfortable with the counterparties. First, we got to figure out who do we trust. Then we got to figure out what is the risk. Then we have to figure out how to disclose that to the public shareholders. Right. Then we have to figure out what the legal issues are, so there's a lot of work to get that last 4%. And what's a more profitable use of time? How about borrow $1 billion at 0% interest? The $1 billion at 0% interest was invested in Bitcoin at 20,000. And so, or not at 20,000, but the 650 million was invested at 20,000. So, we made almost, 500 million off of that, or 400 million. We made a lot of money off of that, some amount of money. You can do the analysis, right? So what we're doing is we're carefully thinking through what's most accretive and then what's best for us. If I was an individual and I had 5 years holding Bitcoin and I knew, I was much more comfortable in my position and I was a private individual, and then I had a good comfort level with whatever the entity was offering me yield, then maybe I might enter into that. I think ultimately the first step is you establish Bitcoin position and you find out how you want to custody it. And that's a major debate, right? We could spend hours talking about how you should custody it and then how you should acquire it. I think the second step is banking a Bitcoin. Do I borrow against it? Do I lend it? Do I generate yield on it? And it's second order. It's important in time, but I tend to fall into the camp of the obvious thing to do. If I bought $1 billion of property in Manhattan 100 years ago, I would have held it for 100 years, and then I would have mortgaged it, and the Fed would have printed 7% more money every year, and the value of the property in Manhattan would have gone up more than 7% a year. And then I would have taken loans tax-free to live off it. And then 100 years later, I would have bought the property for 20 million. It would be worth $1 billion. I would have 700 million of debt on it after 100 years. I'd have 300 million in equity, and I never would have generated a taxable event. And I probably, maybe I would rent it. Maybe I'd rent, maybe I'd have a rental business there and I'd be doing financing and I'd be thinking about managing the property, but that's the way to think about that.
So
one point I'd make,
please,
that's interesting, if I could, if you roll the clock back 1 year, now we have hindsight. If you had $1 million, or if you were sitting in a position where you could have invested $1 million a year ago, or 100,000, pick any amount, and maybe you could borrow 100,000 against a house a year ago, and you think about what you could have done with it. What are the mistakes? If you borrowed $100,000 and you bought gold, you lost 2% of your money. You would have 98,000 worth of gold. If you bought borrowed $100,000 a year ago and you bought long duration government debt, 10 and 30-year government debt, you would have lost 12% of your money. That was an awful idea. Pretty stupid, right? Why would you ever buy debt and loan the federal government money for 30 years for 1.2% interest for 30 years, right? I mean, hopefully no one would buy 10-year and 30-year debt. 10 years were yielding 70 basis points or 50 basis points and the like. So those are two mistakes. If you borrowed the money and you just held it in cash, you would have the money and you would pay 2%, and so that's that. But what if you'd done everything else, right? If you bought a house with the money, Single family houses were up 24%, according to the headline in the Wall Street Journal last week. Okay, so if you bought a house 12 months ago, that was smart. Not a bad idea. Why you bought a scarce asset? If you bought a portfolio of S&P stocks, you were up 40%. So you would have had a 38% arbitrage. You would have made 38% on the loan. If you bought big tech, you're up 47%. If you bought Bitcoin, you're up 294%. You could probably list a whole set of meme stocks that did even better, and probably some cryptos that did even better. They all have more risk, but it's like take a flyer. If you did it, great. Myself, I'd like to invest in things that I can hold a decade. I wouldn't be holding AMC stock or GameStop stock for a decade. Even, you could have made money on Carnival Cruise Lines and the airline trade, but I just wouldn't do it because I want to buy something and hold it for a decade. But generally, what's the one mistake? Unless you were going to buy gold or long dated sovereign debt with the money that you borrowed, the one mistake would be not to have borrowed the money. That's the biggest mistake, because you almost couldn't lose money investing in anything, right? I'm sure people did. How do you lose money? You trade it, right? You basically buy GameStop, you short GameStop on margin, or you do some kind of short dated trade. And I've lost money on short trades. There is nobody in the world that, here's what I think about that. No one in the world is so smart they can guarantee your short-term trade is going to work. And any trade, no matter how intelligent it is, can be made to look scary if I compress the time frame enough. If I zoom in on your face with a 10,000 to 1 magnifying glass, I'll find a blemish. And if I track the most stable thing down to the 1 second gyration, I will find anxiety. One point I made to people is, if you took $1 million and you bought a house, and then you went to everybody you could find in the world every minute of the day on Saturday night while you're drinking tequila, and you said, will you buy my house for me for more than I paid for it? You would probably find someone at some point that will say, no. You would probably find someone that'll say, I don't want your house. I'm not going to pay you anything for it. Or someone else would say, I'll give you half. And if you then said to yourself, oh my God, I lost half my money, I found someone that was willing to give me half, you would just give yourself a heart attack. If you keep oversampling, if you sample everybody all the time, you're going to create anxiety. And the problem with Bitcoin and cryptos in general is they're sampling everywhere in the world all the time. And so if you fixate on it, it's going to give you anxiety. And the only thing you can do is buy or sell, right? And so if you buy and hold, that's good. And at any point in the history of technology, if you had sold, you made a mistake, right? With the one caveat, you have to buy the winner. You have to buy the category killer. You buy Facebook, Google, Amazon, Apple, Microsoft. And so the question is, how long do you got to watch them win before you decide they're the winner? I think 30 years is a bit late. If you got to wait for 30 years before you pick the winner, right, you probably won't get outsized returns. But you could have watched them win for 10 years and bought them and still made a lot of money.
And that would be Bitcoin under $4,000 last year.
Yeah, I would say.
It's got the Lindy effect. It's been in existence long enough that you know that it will continue to be in existence. So it is an apt analogy to say it's like buying Amazon 10 years in.
I waited 10 years. Like if you bought it in 2013, you were inspired and you took a lot more risk and there's a lot more question mark. But waiting until 2020, how about 2021? Really? Are you still gonna classify it? It's certainly more stable and more successful than Facebook, was in 2012, or Google. If you look at the market caps and the stability of Facebook and Google and Amazon and even Apple, you can find that it was 98% skepticism on those stocks 10 years after they had established their business model. Even
and more
Microsoft.
volatility and more volatility than Bitcoin in many cases.
It's like, yeah, I mean, Facebook was the idea that I'm going to collect and channel all the social energy in the world on a digital network, dematerializing friendships and communications and, you know, the like. And it was a totally revolutionary idea, but it's worth $1 trillion this week. Tipped.
Well, I want to pivot a bit to China, because I think we
Yeah.
both agree that they're making a monumental mistake cracking down on Bitcoin mining. As I mentioned, I talked to Vijay Boyapati, and he posited that it was about bureaucracy and actually the Communist Party disallowing lower level members to profit from Bitcoin, and not really about energy, which is the narrative, since, you know, Sichuan, we know, is largely using an excess of hydroelectric power. I mean, can you talk about the situation in China? Why do you think it's happening? I know that you believe it's $1 trillion mistake. Especially in context of the timing. So what do you think the real story is there?
Look, the real story is capital controls in China. The Chinese don't want capital to flow out of their country. They want to keep, they've got a closed economic system. You know, for example, stocks in the Chinese stock market would trade with a PDE of 30 when they were trading with a PDE of 15 in the US stock market. I remember going to China and I sit with business people, okay, and they would say, yeah, well, you know, you should take your company public on the Chinese stock market because you would get a 40 multiple instead of a 10 multiple. I'm like, okay, but they're like, yeah, but the one problem is you can't like get the money out of China. Okay, it's closed system, you know, and then their problem is they can't get money out of China. So this has been the case in China forever. The Chinese currency is pegged to the dollar, and it's been pegged to the dollar, but the only way to keep it pegged to the dollar was to prevent the capital from flowing. I think that at some point, the Chinese decided that there was too much potential for capital to flow out. One way to evade the capital control is to buy Bitcoin mining equipment and then mine Bitcoin, and then you've got hard currency. The other way would be to trade OTC Bitcoin. So I think you had a lot of people in China that had a lot of Bitcoin, a lot of capital. Like what do you want to do? If you're a Chinese billionaire or you're a Russian billionaire, what do you want to do? You want to get your money out of the country, right? Why did the Russians always own yachts in the Med? Because if it's floating capital. I put the money in the boat, I float the boat out of the country. You know, so there's this issue there. I really think that the number one thing is they want to control the capital and they want to use that to control their markets. The number two thing is the environment. 70% or more of Bitcoin mining in China is coal powered. So I think they use that as an excuse, but I really think the environment is always the excuse. Any kind of concern like that against the primary issue, which is just controlling the economy. Now, I think that the rest of the world's different because the Chinese have a hard peg. I mean, CNY is pegged like 6.5 to the dollar, and there's all sorts of speculation. The euro is not hard pegged to the dollar. And so if you have freer floating currencies with the pound, the euro, other currencies that don't have that kind of hard peg to the dollar, they don't have the same kind of requirement. I think as long as the cap, by the way, I don't think they've actually outlawed owning Bitcoin. I think they've, so you could own it. I think generally politicians look at this and they say they want to protect the tax base. And if they have capital controls, they have to defend the capital controls. So any country that has capital controls you can look at will eventually put tighter restrictions on Bitcoin trading. You know, the problem in China is that they can convert Bitcoin to Tether, and if Tether can cross national boundaries, then they've got porous capital controls, and you can't have a capital control policy and allow people to freely trade past that. So you have to clamp down on the exchanges that would allow that. And that's what's going on.
Do you think any of it's related to the development of their central bank digital currency?
Not really. Like if I had $10 billion in China and it was invested in the Chinese stock market and I wanted to sell it and I wanted to put it in the United States at JP Morgan and buy the S&P 500, they wouldn't let me.
Right.
I mean, the first order issue is they want the money. Like if there's hundreds of billions or if there's hundreds of billions of dollars in China, they do not want anybody in China to move that capital to New York or London. They want to keep the capital in their system. And so that's the Chinese wall. The Chinese wall is an internet wall and a capital wall. It's not new. For example, the Chinese banned Facebook, the Chinese banned Twitter, the Chinese banned Google. The Chinese won't let you have data outside of their country. So there's a very hard wall. And the Chinese don't want you to move capital. And Bitcoin just happens to have gotten to the point where it was material. If it was immaterial, I mean, they'd already, they shut down conversion of fiat CNY currency to Bitcoin in 2017, right? You know that, you followed that story, right? And so they just left this loophole, I guess, where people were trading. I think they shut the retail trade out and they left the institutional trade functioning. And probably what you had was a lot of very wealthy, powerful people in China, probably that had control of provincial governments, and they were mining Bitcoin and trading it, and they had that opportunity. Whereas the billion people and the consumer working class did not have that access. And the Chinese closed that loophole. The entire China exodus is really forced, rushed exodus of capital from China. I got $1 billion of Bitcoin, I have to sell it. And I have to sell it in a hurry before I get audited by the Chinese government or before someone comes and asks me why I'm holding this, and I need to convert it into local CNY. So the Chinese have a history of providing amnesty. So you have 3 months to clean up your act. Just like the US, at one point they said, well, if you have money in a Swiss bank account, you have 3 months to declare it and pay tax on it. And after that, we're going to bring charges against you. And lots of people declare it and get clean, and the other ones don't, and they get prosecuted. So this happened. It happened in 2017. The country gave people some number of months to move their exchanges out. There's OK Coin and there's OKEX, right? And they split, because you couldn't be trading fiat to Bitcoin in China. So they gave them amnesty. I think they gave them another amnesty. I think you saw this kind of rolling exodus of mining and exodus of capital. Who are the big winners? Look, my company buys Bitcoin at 35,000. I would have paid 70,000, Scott. If this had not happened, then Bitcoin would have gone 60 to 70 to 90 to 100. We'd be paying 100,000. So people buying Bitcoin in the 30s got Bitcoin at a discount. You got two types of people. You got the long-term people that said, but for the Chinese exodus, we would have had to overpay. And you got the short-term people that said, you're so stupid. You bought it at 50,000 and now it's 35,000. You should have shorted it. Well, shorting it is like shorting electricity. It's like, no, I don't think so. If you think this is a Rorschach test. If you understand that Bitcoin is digital property rights for 8 billion people going to change the earth, then you think this is just volatility and it's a buying opportunity and it's a windfall. And if you think Bitcoin is a random speculative gambling asset of no consequence with no underlying value, then you think, it's like you were stupid. You shouldn't have bought it. And obviously the technologists that understand it, we think it's a decentralized, sound digital property network that can serve as the basis of the 21st century economy. This is $1 trillion mistake for China because they had 60% of Bitcoin mining. It was worth 12 billion a year plus all the Bitcoin, and it was doubling every year, and it was going to $100 trillion. And they could have had trillions and trillions of dollars. And instead, they held a gun to the head of their holders. If I said to you, Scott, 15 years ago, if you owned half of Google and Google was worth $50 billion, and I said, you have to sell all your stock in Google, how much would you have lost?
I mean, billions and billions of dollars.
It's like
tens
a
of billions of
forced
dollars more, yeah.
liquidation, right? It's a forced liquidation of the dominant digital property network on Earth. They forced themselves out of the business. So that's why it's a geopolitical mistake. It's a tragedy for the people in China that own Bitcoin. I feel awful for them. Like it's just a tragedy. Now they got to, but for the Bitcoin miners in North America, it's a windfall.
Right.
Their revenues are going to double. Their costs are the same. Their margins have quadrupled or quintupled, right? It's like in any business, right? If I went to Pepsi and I said, guess what? I'm going to outlaw Coca-Cola and obliterate all their factories worldwide. What do you think? Like, sounds like it's a good thing for Pepsi. That's kind of what happened here, right? North Americans were a bit behind. The big FUD in the market was, oh yeah, Bitcoin is dirty. Well, 75% of the power in China was coal. So China was the dirtiest miner of Bitcoin. The next FUD is China might take it over. That's not happening. The next FUD was they dominate mining. That's not happening. The next FUD was it's a secret to undermine the dollar by the Chinese. That's obviously not the case. So now that you're through the China FUD and you're through all the Bitcoin is China coin type ridiculous narrative. Now the next question is, well, is Bitcoin good for the world? Well, it's good for the rest of the world, right? It's good for the dollar. What you can see here is that if you're free floating currency, then you're going to see the US dollar float to 5 billion people's mobile devices, and Bitcoin is going to be the underlying protocol to synchronize all 5 billion devices. And if you don't synchronize on Bitcoin as a settlement network, you'll synchronize on Lightning as a transaction network, or you'll synchronize on another layer 2, a proprietary layer 2 controlled by Binance or Coinbase or Square or PayPal or Apple or Google or Facebook, that then in turn settles on the underlying Bitcoin settlement network. And so the architecture of the world is becoming clear. And Scott, you know, when I wrote the book, The Mobile Wave, what I said was, and I said, buy Apple, Amazon, Facebook, and Google because they're the dominant digital networks in the Western world. China closed off China to Google and Facebook and Twitter and Amazon and the like through capital controls and information controls. And then they created their own version, Alibaba, WeChat, right? Alipay, right? So Weibo. So China created its own little world. And what you saw was the Westernet, which consists of Western Europe, the United States, the rest of the world, that became one ecosystem. China, with their billion people, became the other ecosystem. And then you saw the category champions in both ecosystems. But ultimately, you know, like, yeah, I would rather own Google than own the equivalent in China, especially because at least Google gives you right to property, which you can take to Sicily or Paris or London, and you can live in a free economy. Whereas if you've got all your wealth and your business trapped in China, it's a closed system. You have to stay within China. You don't have access to the rest of the world with it. You can't take your capital. And so ultimately, they close themselves off, which, you know, it works in the near term, but on the long term, Are you going to bet against Google? I'm not. Like, I don't think I want to do that, right? Like, so that's what I think about that. That's helpful.
It is. It's interesting. I mean, China is obviously an example on one pole of what we could see from governments. But then we have countries like El Salvador. Obviously, they're adopting Bitcoin as legal tender, talking about mining volcanoes. Where do you think that most countries in the world will fall, between those poles as they start to actually address
I
Bitcoin
think
as a
they'll
real
be in the
asset?
middle. I think that I think you're going to see digital property, digital currency, and digital applications, Scott. And digital property is Bitcoin. It's like the block of Cyber Manhattan, and it'll be based on a proof of work network, and it'll be mined. And digital currencies, they're going to be stable coins and CBDCs. They're going to be with digital property, you optimize it for integrity and durability. Well, you want it to last for 1,000 years, like the city block in Manhattan. It's on granite. Manhattan's built on granite. That's why it's still there 300 years later, because you can build something, it's still there. You don't build on sand, you don't build on clay, you build on granite. Do you want it to move fast? No. You don't need it to move fast. Does it need to be functional? No. It needs to be inertial. If I'm going to lean on something, I need to know it'll be there in 100 years. What happens if you build on sand? Well, what happened at Surfside in Miami Beach a week ago, right? That's what happens, right? It's riskier. You build on granite, you build steel, it's heavy. That's property. The currencies are going to be optimized for compliance and compatibility. You got to do transactions, and you're going to get KYC, AML regulation. And I think you can expect most countries, they're going to wrap any exchange and any functionality around stable coin with AML KYC, because it's just natural, because they want to make sure that capital doesn't evade their tax or their regs. And then I think you got digital applications, the smart chains, smart contracts, DeFi, all the functionality. Well, applications are optimized for functionality and performance. I need to do 1 million transactions a day. I need to do 1 million a minute. I need Turing complete. I need to do flash loans. I need to do stuff. What are they trying to do? Well, if they're a platform, they're wanting to be the building on the city block in Cyber Manhattan. It's like, because what can I do with a building? The Rockefeller Center is standing in Manhattan. It's nearly 100 years old. The city block is 1,000 years old. The Rockefeller Center probably stand another 100 years, but maybe not much longer than that. A lot of businesses have come and gone in the Rockefeller Center over that 100 years. Insurance companies, banks, discotheques, restaurants, membership clubs, condos. So digital applications are either a platform or they're an application. And the question is, are you making an investment for a 100-year time frame? Are you wanting to own the building for the next 50 years? Are you wanting to own the business that might be good for 5 years? There's some businesses that lasted, 50 years, not many. Right. So I would say it's like property is a 500-year time frame, a building or a platform is a 50-year time frame, a business is a 5-year time frame or 10-year time frame. They've all got different risk reward. It takes a lot more capital to own the property. It's capital intensive. Right? You can start a business in New York City today and you can rent the space for a year. Right? It doesn't take a lot of capital to start the business. To build a building is intermediate capital. So how much capital do you need? What's your time frame? What's your risk tolerance? And Bitcoin will be regulated as property, and you'll pay property taxes on it, and you'll have to disclose. I cannot transfer, $1 billion of property from here to Africa privately without paying taxes on it.
Of course.
Right. On the other hand, an application, if you're going to get in the insurance business and you're going to sell life insurance on a DeFi network to a consumer, you're probably going to get your door knocked on by an insurance regulator that's going to say, you sold life insurance and you violated the following, life insurance restrictions. You're overcharging or undercharging or whatever you're doing. And if you're going to trade stocks, if you want to trade Apple stock as a token on Saturday night in the United States of America with quintuple leverage, the SEC is probably at some point going to say, it looks like you're an exchange. And since we've already said you can't trade with that kind of leverage on exchanges, we have a problem with you doing it. Or if you're going to trade commodities, the CFTC is going to say, if you're going to let American citizens trade commodities in competition with the CFTC, there are rules, right? Like everybody's got their regs. So if you want to trade Eagles music on an NFT network on a platform and you're actually going to upload it, try uploading an Eagles music video to YouTube and see how long it lasts before they rip it down. You'd be like, well, that's fair use. Can I just use the music from the Eagles, in the beginning track of my podcast? And the answer is no, you can't. Okay, so I think that as you build application functionality, you're going to invite application level regulation from the jurisdictions where you do business, and it's going to be slower. It's going to take a while for people to figure out what they think about it. And it's going to be very asymmetric and jagged, right? Like some jurisdictions will move more aggressively faster than other jurisdictions because of their political sensitivities. So that's kind of what I think will happen. And if you're making investments, you kind of have to figure out, what jurisdiction am I in? Right? El Salvador said, we're not going to charge you tax if you transfer Bitcoin. Okay, well, if you're an El Salvador citizen, that's a great thing for you. But if you're a United States citizen, you're going to have to surrender your passport and be an expat for 10 years before that's going to be a good thing for you. Right? So everybody's got their different thing. I don't really think that Bitcoin's going to be currency in the US ever, nor do I think it should be. I really think logically, it should be treated as property. It's like owning a building or owning a bar of gold or owning a share of stock. It's property. And what it's doing is it's demonetizing other forms of property. If you have $1 million and you have to choose whether you buy collectibles or a house or a second house or an ETF or a share of Apple stock or start a business, or buy art, or buy a bar of gold, or buy Bitcoin. That's the fungible decision you have to make. Where do you want to store your monetary energy? And clearly my message, I even posted today, it's like, gold is no longer a store of value for monetary energy. That's why it's up 0% in a year where the S&P 500 is up 400%. It's pretty clear the marketplace thinks that stocks are a better store of value than gold. And the marketplace thinks Bitcoin is a better store of value than stocks. So ergo, digital property is demonetizing, it's demonetizing other traditional assets. And I think that the way the world will revolve is eventually they'll figure the best architecture for digital property is proof of work, decentralized Bitcoin mining, or mining in general. And I think that the architecture the world's going to adopt for applications is proof of stake of some sort. Lightning is a proof of stake network. It's just stake with Bitcoin. These other staking networks, they're staked with something. I happen to think that if you're going to have a staked network, you're better off to stake with a financial asset that is uncorrelated to your network. So for example, I staked my debt instrument, my $500 million loan with cash flows from enterprise software, right? And then I bought Bitcoin. So I created an uncorrelated asset. Bitcoin miners stake dollars. They use dollars and they use technology, mining rigs, and they use political capital. So technical capital, financial capital, fiat capital, political capital, engineering capital, and human capital. They use people to create a mining operation that stakes the Bitcoin network.
Right.
And they use energy too, right? So 5 different flavors of capital to stake Bitcoin. The Lightning Network uses Bitcoin to stake it. You could even argue Ethereum 2.0 will be using Ethereum 1.0, which is a proof of work GPU mine network to stake it. You see, so to the extent, if you were going to spin up your own application, Square Cash and PayPal, they have layer 2 applications staked with Bitcoin. Binance and Coinbase have applications staked with Bitcoin, and MicroStrategy issues stock and convertible debt and straight debt, which is a derivative staked with Bitcoin and political capital and other things, right? So the way that you get stability in a network is hopefully you're open to another form of energy, so that you're not inbred, self-referential. If you create, yo-yo coin, and you create yo-yo network, and you give yo-yo coin to yourself and your friends, and you stake your yo-yo network with yo-yo coin to create, virtual security so that you can do virtual functionality, you just create a second life. But by the way, I'm not even saying it's not valuable. Like Second Life and Fortnite are valuable.
Right.
You've created a virtual gaming ecosystem, Farmville. You can have Farmville with Farmville dollars and stake and buy skins and the like. It's a question of, on the continuum from game to casino. I go into a casino, I buy a bunch of chips. Maybe they're not redeemable, they're only good, for the casino, but they're valuable. Have I gone from the game to the casino to the application to the bank to property? I think that if you want to create property that's good for 1,000 years, then your best architecture is one that uses political capital, energy capital, external financial capital, semiconductor capital, and tech engineering capital that are all external to the network that you're attempting to stake and to securitize.
Yeah, I 100% agree that it'll be treated as property, as it already is. My only fear with that is that if the world ever does move to a Bitcoin standard, that you're de-incentivized to actually spend it when it's needed. Obviously, buying a cup of coffee with Bitcoin is a bad idea right now because of the tax implications.
I don't think you ever need to. Look, I don't think you should spend property. I think that this is a fundamental misconception people have. They keep thinking they have to spend it, or it has to have a use or utility for it to have value. The reason they think that is because they've never been rich. Like, I mean, it's really non-rich people that think that. For example, if my family had bought up 20 blocks of Manhattan 200 years ago, would I have to spend my real estate on coffee does Manhattan have to have value? Like, isn't it obvious that owning all of Manhattan and not giving away any of it for 200 years is probably a better investment, a better idea, right? It's property. Like, how about Robert Kraft? He owns, the New England Patriots. Does he spend 1% of the New England Patriots to buy coffee? Does he give it away every year so it'll have value? No, he owns it. Is he giving? What's he going to do with it? Give it to his kids if he can, right? It's a dynastic thing. The United States doesn't give away its land to foreign countries to buy coffee, right? So if you have real wealth, if you have a franchise, if you own Manhattan, if you actually own, like, Jeff Bezos didn't get rich by spending Amazon stock on coffee. Jeff Bezos got rich by not spending Amazon stock. Larry Ellison still owns Oracle. How did he do it? He borrowed against it, right? Rich families, rich countries, they borrow or they generate yield on it, right? If I own Manhattan, I can either borrow against it or I can let you build a building on it, but I keep ownership of the underlying property. A lot of the property in Europe, the noble families like the Prince of Wales, whatever, they own the land underneath London. And then people that have buildings, they don't own their land. They have a 100-year lease or a ground lease or a 200-year lease or a 50-year lease, but they don't actually own the property, right? Sometimes the government owns the property. And in UAE, it's illegal for a foreigner to buy land on the beach. I think all of the prime beachfront property, it's impossible for a foreigner to buy it. It's against the law. So if you think, once you understand property, you understand that if I gave you $1 billion of property, you could pretty much just stay rich forever and you don't have to spend the property. All you got to do, borrow money at 2% interest against the property, invest it in the S&P that yields 10%, scrape the 8% yield, never sell the stock, never sell the land. Just you're living off of rent or arbitrage off the energy. And that's, I think VJ understands that. What VJ would say is the reason that Bitcoin is good money is because there is no utility value for it other than as money. Like if gold is not a good thing to monetize because it has value as jewelry, and corn is not a good thing to monetize because it has value as food, and a house is not a good idea to monetize it because it has value to live in. You want to monetize something which is 100% monetary premium, and to be a 100% monetary premium, you don't have to spend it. I think the big idea that people just don't get is they don't understand that under inflation, money decomposes into a currency and an asset. So in a non-inflationary environment, this is first principles reasoning. If the US dollar was never printed, if the US dollar was not inflationary, then it would be a store of value and it would be a medium of exchange and it would be a unit of account. But when I decide to print 10% more dollars every year, it becomes a medium of exchange, a unit of account, but the store of value disappears and it drifts. And the store of value becomes sovereign debt or gold or S&P 500 stocks or equity or Bitcoin, something. So when the dollar inflates 20% a year, it's pretty clear the currency is no longer a store of value. When the currency inflates at 80% a year, it's not, it's losing its value within 6 months, and so it starts to just totally break down. If you understood that, once you get that idea, you realize that for Bitcoin to have value, you don't have to spend it, you have to hold it. And the way that you execute your life is you fund your checking account or you fund your working capital by borrowing or generating yield off of your asset. So I have $1 million of Bitcoin. I borrow $10,000 against it. I don't sell the Bitcoin. I pay 3% interest. Bitcoin goes up 10 or 20% a year. I keep funding a USD checking account against my BTC savings account. And then the asset will go up faster than my rate of expenditures. For that to work, all I need is a bank that will either generate yield for me or it will give me low interest loans. So you need Bitcoin Bank. Every rich person in the world, every wealthy person, they have billions of dollars or hundreds of millions of assets. They have banks, and the banks are going to give them financing at LIBOR plus 50 basis points against their equity portfolios, or LIBOR plus 200 basis points against their yacht, or LIBOR plus 100 basis points against this, or they're financing their business at the junk bond. Every business can borrow money at 4% interest in the junk bond market, right? And so, or they're going to banks, they're saying, I have $1 billion building, and they're refinancing it with a building construction loan at 3% or 4% interest. So they're all continually financing their assets with a mixture of debt instruments in order to avoid capital gains, in order to avoid income tax, and in order to avoid shrinking their asset portfolio. Because if I have $10 billion of real estate, and if you can predict that the Fed is going to print 7% more money a year, and if the real estate's in New York and it's scarce, can't you reasonably assume that the real estate's going to go up by 7% a year?
Of course.
And doesn't that mean that your $10 billion of real estate is going to be worth an extra $700 million next year? And doesn't that mean that you can refinance it and you can take $100 million a year out of that at 2% or 3 or 4% interest, tax-free forever?
Yes. What about for a poor person who has $100 in Bitcoin and can't find somebody to lend against it?
It's the principle is the same at all scale, which is you want to divide your assets into a savings account that's in an appreciating asset, BTC, and a checking account that's in a depreciating currency, the same scale. And look, if you're a poor person, the only way you generate wealth is you have to generate assets. So how do you do it? You either create a company, issue yourself to stock, or you have to save money at another job. And then when you save money, you go buy something. You can buy a house with leverage. So if you can make enough for a down payment, then you can buy a house and the house goes up 7% a year. And then you can generate home equity. And lots of people did that, right?
Mm-hmm.
Lots of middle-class people generated wealth by owning their own home because they were able to buy it with leverage. You can't do it without leverage. It's hopeless without leverage. Now, once you've done that, right? I mean, the classic thing is I get a job, I get a down payment, I buy a house, it appreciates, I flip it, I buy another house, I get more debt, I pull the money out, and then I make an intelligent investment in the stock market or intelligent investment in a business that appreciates. Now you have assets.
Right.
Now, what don't you ever want to do? You don't ever want to shrink your balance sheet. Ultimately, what you want to do is construct the balance sheet of the greatest amount of high quality assets. Definition of high quality asset: one that a wealthy person will want to buy in 10 years. That's a good definition.
Sure.
I mean, common sense. A house in the Hamptons is a Picasso. How about, you bought 100 acres in the middle of Kansas and you paid a lot for it. Well, maybe it doesn't seem scarce. It doesn't seem desirable. It's not going to appreciate as fast. So find scarce, desirable assets. The other thing is find something which is not going to force liquidate you. You buy Dogecoin, on margin, and you might get wiped out before you make your money on it, right? So some things are riskier than other things. I think ultimately, the big disservice we do is we tell people, you have to spend something for it to have value. You don't have to spend shares of Apple stock for it to have value. I mean, it's such a freaking stupid thing to say. You don't have to. Mark Zuckerberg never spent a share of Facebook stock to be rich, right? Okay, I got $1 billion of Facebook stock. I'm in real deep trouble because I can't spend it on coffee. No, I pick up the phone, I call the bank, I say I have $1 billion of Facebook stock, and they loan me $100 million at 1% interest. And I spend $100 million over the next 10 years. I never pay income tax. I have no capital gains tax. And the only question is Facebook going to go up or down over time? And if Facebook is a franchise, then when am I going to sell it? The answer is I'm never going to sell it. If you look at John Malone's life, John Malone is one of the great businessmen. He's one of the true genius cable billionaires. And if you read the story of his life, it was all about, I bought this business, I did a tax-free merger with that business, I leveraged up that business, I sold to AT&T and did a tax-free spinoff, I leveraged that business. He still owns all of these cable companies and these cable networks after 40 to 50 years, never selling, And the number one reason is he never wanted to incur a tax, right? That, I mean, it's the tax that kills you, especially capital gains tax. And so you just want to buy assets and you want to find a way to build up your asset portfolio however you can with, and generally what's the best thing? Long-term, patient, low-cost financing. 10-year debt, 20-year debt. It's like, if you don't believe and if you don't believe what you're investing in and you borrow money against it, you're going to get wrecked. Okay, so maybe you don't want to launch a bakery or a restaurant. How about just buy the S&P 500 index with long-term debt? I bet you if you did the analysis for the past 40 years and you considered if someone were to basically take a home equity loan and then reinvest it in the S&P 500 and just roll that forward for decades, you probably would be fine, right?
Sure.
Like that would have been a simple thing. Leverage up your house, take as much equity as you can out of your house and buy the S&P index. And you probably, the S&P is up 10% a year for 100 years. It's up a lot more right now. I think generally you might find 1 year when it might have been ugly, but if you just held that position for your entire life, this simple idea, borrow money cheap and buy a diversified portfolio of company stocks is not an awful idea.
So the average person is going to eventually have to borrow against their Bitcoin.
Yeah, I think either that or generate yield. You'll either have to go to a yield strategy or you have to borrow against it. But, and again, some people live in fear of that. If you're really hyper conservative, you get a job and you live off of your earnings from your job, and then you let your Bitcoin appreciate unleveraged. But I don't think you can find, I mean, I don't think it would be untrue to say that 95% of the businesses and 95% of wealthy individuals have some debt. I bet you'll find that most of these sports team owners, 80-90% of the sports team owners that own these franchises, they all have debt on them.
Of course.
Right. So they're not afraid of it. I mean, their view is find an asset that's not getting marked to market, right? And find a friendly bank that'll loan me money against it. And, so leverage it up 50%, 30%, 20%, 80%. If I bought a house right now and someone offered me 2.5% interest, yeah, I put debt on it. I mean, like,
Sure.
why wouldn't I put debt on it? The cost of capital is 40% this year. That's the key. The best surrogate for cost of capital for an investor, in my opinion, is the S&P 500 index. It's just a broad portfolio of desirable assets. And if you look at it, if you can borrow money at less than that, then you can always buy the index, right?
Yeah, of course. Yeah. I guess the question is then, when do we have a reliable bank that will allow us to borrow against our Bitcoin?
Well, you see the Bitcoin banking industry evolving, right? BlockFi, Abra, they're all, and Celsius, they're all bringing out offerings, and they're all pretty material, pretty big players for consumer loans. I think Abra announced that they would give you a 0% loan up to 10% of your loan to value, or 4% loan. They're all offering 2, 3, 4 to be anywhere between 1 and 8% or 1 and 9%. The catch is really just how much collateral do you want to post? Right. So like if I post $1 million, I could borrow $100,000 for
almost
free.
Nothing. Yeah, for free. They
will take it and they will lend it out. But if you think that Abra is a reliable counterparty, you can have a loan for $100,000 for 0 interest. Or, if you want a 4% loan, you can get that. And I think the loan to value tranche is 20%, 35%, 50%.
It is.
If you want to borrow $500,000 against $1 million in Bitcoin, they charge you 8 or 9%. So yeah, I'm not a big fan of of getting too leveraged, right? Like if you figure that Bitcoin could draw down 50%, then you don't want to be at a 50% loan to value because you're on the edge. But, 20% loan to value, could you live there? You just want to keep it below that. I mean, it's not quite as good as what we've done, because if you get an 80% drawdown once, you could still get force liquidated. So on the other hand, 10% loan to value, 10% is okay.
Yeah, you're pretty safe.
I think that the market will evolve to the point where there'll be other banks that will just give you a loan where they don't require custody. You just, like, there are banks where if you just represented them, you own the property, and they look at your balance sheet, they're like, okay, well, you have $10 million worth of Bitcoin. I'll give you $1 million loan or a $500,000 loan against
That's what
that.
I meant. That's what I meant. Like you borrowing against a yacht, the bank doesn't take your yacht until you pay back your loan. They know that you have the yacht.
And you know what? There's one bank that will, if you take the top 5 banks in the United States, there's one that makes most of the yacht loans, and there's 3 that won't make a yacht loan. I don't care how much money you have.
Right.
If you
gotta find the right bank.
If you walked in, you were Bill Gates or Jeff Bezos, they still wouldn't loan you money against the yacht because they just don't trust the collateral. And so you got to keep in mind that these are asset classes that some players are willing to finance and securitize and lend against and insure, and others just won't. Right? You'll see a wide discrepancy in views. So with Bitcoin, you would expect that there'll be some banks, some people that will get very comfortable with their Bitcoin. Generally, if I post $1 million of Apple stock as collateral, I've got banks that are getting very comfortable with giving me a margin loan because they are the custodian of the shares. But if I said I'm not going to post the shares, they would be much more skittish. And that's with regard to stock, simple stock. So you can expect the same thing with Bitcoin. And I think we're still early on, right? I mean, I think like the era of institutional acceptance of Bitcoin started in March of 2020.
Right.
That was year 0. And then year 1 was like February of 2021. So we're kind of like in the year 1 or the second year, maybe, now if that was the first year, the second year, and it'll be 10 years. And, each year for 10 years, I think Bitcoin hardens and matures as an asset class. People get more comfortable with it. The terms will get better. And like right now, I'll give you an example. Like if you had $500,000, you could buy $500,000 of Bitcoin, and you could buy $500,000 of Grayscale. Some banks will give you a loan against Grayscale, some won't. You could buy $500,000 of MicroStrategy stock. Some, MSTR stock would be marginable in a JP Morgan account or, a typical conventional banking account. There's some banks that are not likers, right? That wouldn't actually let you hold MSTR in their account, but most would. So you have certain companies, like my company is a Bitcoin derivative, and you could borrow money at LIBOR plus 100 basis points, via a traditional wirehouse in a margin account, whereas you couldn't borrow against the underlying Bitcoin. So what we're doing is we're gradually spreading exposure to Bitcoin to different classes of investors. MicroStrategy, brought Bitcoin to institutional equity investors. Our converts bought Bitcoin to institutional convertible arbitrage funds. And that secured financing we did bought Bitcoin to institutional fixed income funds. And then when the Bitcoin ETFs come out, that will bring another type of Bitcoin. And I think that as that happens, the banking issues will become more common. And I think the difference in terms and rates will start to narrow. And at some point, Bitcoin is better collateral. $1 million of Bitcoin is better collateral than $1 million of Apple stock.
Way better.
Because on a Sunday afternoon, if there's a catastrophe, there's no liquidity in Apple stock,
right?
But there is liquidity in Bitcoin. So if I'm a risk manager and I'm a loan officer evaluating the risk of this portfolio of collateral against the loan I've extended to you, Bitcoin should be a better collateral. It's just going to take a bit of time for it to metastasize or for it to spread. And it is spreading, right? I mean, if you look at the terms and the engagement, coming out of Abra and BlockFi and Celsius this year versus 12 months ago, I mean, they've come a long way.
Yeah.
And I think I've seen, I mean, you saw Square applied and they got a banking license. And they're getting into small, mid-sized financing, trade financing. And you saw PayPal set up, their system where they said you could pay in dollars and fund in Bitcoin. Well, the next thing is Square and PayPal get in the business maybe of giving you credit lines against your Bitcoin. It's kind of inevitable. Lots of these companies are offering a credit card. Like they're offering, BlockFi's got, I think, a credit card coming. I saw one. So if they give you a credit card or a debit card, you're not that far from, you're just living off of a credit line secured by your assets. And, again, if the asset goes up at 20% a year, and if the interest rate is 4% a year, you can actually calculate, if you have $1 million and the asset's going up at 20% a year, right? Then you can calculate that you can reasonably spend $40,000 a year and never run out of money and just keep rolling forward the debt, right?
Yep.
So it's kind of a simple thing. You can spend 5% of your assets forever as long as your assets are going up at 10% per annum. So I don't think people are, everybody's been in the business for a decade. They remember a different world, right? Okay, well, the last decade, people that came to America in the first 100 years, they all died on the banks of the Potomac River. Go, read the history of the Jamestown colony and all of the other colonials in 1500, et cetera. That doesn't mean it's like that to live on the Potomac River today. I mean, there's a point at which you go from the Wild West to a safer, regular environment. And I'm not saying we've completely turned the corner on volatility, but this is 50% downdraft. We had 80% downdraft. And, I think that we are seeing a lot more stability as we go forward, and it's indisputable. You could see more institutions entering the space.
Absolutely agree. And I know that we've gone 30 or 40 minutes over our time, so I will let you go. Any parting thoughts or anything you'd like to share where people should follow you after this conversation?
My final thoughts. I really think that the best way to understand Bitcoin is it's digital property for 8 billion people, and it's going to demonetize other forms of property in the same way that digital books sucked the information out of libraries and actual books and universities, and the same way that digital music sucked the music out of your CDs and your records and your phonograph and your piano and the orchestra. It's a simple collapsing of the economy from a high energy state where it's very energy intensive and mass intensive and difficult to provide this thing to 8 billion people, to a low energy state. And when anything crystallizes, lots of energy gets given off, just like the energy when you go from steam to water to ice. The energy that's collapsing because we're demonetizing gold. It's hard to move $1 billion of gold. It's 30,000 pounds. It's hard. It takes you $5 million to move it from place A to place B. It takes $5 to move Bitcoin from place A to place B. As you demonetize property and dematerialize all of these things in the economy that we live in the 20th century, you're creating extreme value. The value is going to accrue both to the underlying asset, and it's going to accrue to all the applications that adopt the asset. MicroStrategy adopted Bitcoin for a treasury. Square adopted Bitcoin. Binance and Coinbase adopted Bitcoin. Every place that this digital property is plugged into is going to benefit, and then owning the property is the benefit. So once you understand that, you understand it's going to be a process that runs 10, 20, 30 years. I mean, the next decade is going to be big. The last decade was clearly big. You just got to look at it as a technology trend, and then obviously invest money that you can hold for the long term. I mean, not money that you need to have next Thursday, because you'll get wrecked or wiped out on leverage. And if you don't understand what I said, go to hope.com. There's a free course on Bitcoin for everybody. There's another set of lectures by Gary Gensler at MIT. There's another course. There's 10 hours of discussions that I've got with Robert Breedlove on energy systems and engineering. There's every book on Bitcoin. There are all the influencers and a ton of leaders in Bitcoin. There's podcasts on Bitcoin. There's tons of video on Bitcoin. Study it until you've concluded that you hate the idea or you like the idea. Because if you're not sure and you're living in fear and anxiety, it's pretty stupid to risk your life savings after 2 hours of study. It took you a lifetime to get the money. So it's funny that people will work a lifetime and they'll make investments in 1 hour. How about you worked a lifetime, spend 100 hours or 200 hours or 500 hours. After you've spent 500 hours thinking about it, maybe then, you make long-term decisions and you'll feel good about it. You don't know why you did it. So I definitely encourage that. And then the third thing is, follow me on Twitter, and I share on there every day. And thank you for the platform, and thank you for the chance to talk, Scott. And I always appreciate seeing you.
Thank you. Yeah, I can't wait for round 3, because I probably could have done this for another 3 to 5 hours. So I do appreciate your time, and we will do it again. Thank you so much.
Okay. Yeah, all the best.